I'm sorry, I just don't have bad news about the housing market this week. For all the crashers out there that are really hoping for that doom and gloom story, I got nothing for you. This week, we're going to talk about what happened last week in the economy, the Fed, mortgage rates, and I have an update for you on affordability as well as what is going on with those underwater mortgages that I talked about a few months back. So let's get right into it, you guys. Last week, the Fed met and it went as expected, right? So they talked about how inflation has eased substantially over the course of the year and that they signaled that it's leaving the door open to start cutting rates in September. So that was all good news and that was all to be expected. And just a reminder why we care about what the Fed does is because the markets react based on that and then mortgage rates react based on that. So we need to pay attention to what's going on with the Fed and with the economy. But then on Friday, we got this crazy jobs report that came out that really moved markets quite significantly. The unemployment rate jumped to 4.3% and job gains total was 114,000. And so that was fewer jobs than expected in July. The unemployment rate also unexpectedly rose to its highest level in nearly 3 years. And so this was actually really good news for rates. Although this sounds like it's bad news, which it isn't great news for the economy in some senses, and of course for workers out there. Of course, this could lead to a recession if the labor market continues to weaken like this. But what it does say is that the Fed is doing its job. They've been trying to slow down the economy to bring inflation down, and now we're seeing that happening or making an impact in the labor market, which is what they've been trying to achieve. So overall, that's good news to markets because that means the Fed can kind of ease up on what they've been doing, maybe actually reverse course and do some rate cuts that we're going to talk about in a minute. So what happened was unemployment rose to 4.3% from 4.1%. And then the expectation was 175,000 jobs added, and it was only 114,000. We also saw that wage growth that slowed to 3.6% year over year, down from 3.9% in June. So overall, this was a very weak jobs report, weaker than anticipated, and markets reacted really positively. In fact, on Friday, they priced in a 70% chance that the Fed will cut the rate by 50 basis points at the end of September. And according to Jerome Powell on Wednesday, before the jobs report came out, he was saying that he wasn't even promising a 25 basis point cut. In fact, he was dismissive of the idea of a 50 basis point cut when asked about it at the press conference on Wednesday, making it sound like a 25 basis point cut was more likely for September if the Fed decides to act. But now, after the jobs report, Wall Street is raising pressure on the Fed to take more aggressive rate action. Traders are now betting the Fed will act more aggressively in the remaining months of 2024. They expect rate cuts of 0.5% in both September and November, and then another quarter point cut in December. So we'll see what really happens here. But after that jobs report, the markets are basically saying, like, you need to change course, be more aggressive because we don't want to go into a recession. We may have taken this too far. There's a strong case to act before September, is actually what JP Morgan chief economist Michael Feroli is saying, that the Fed seems to be materially behind the curve. So he's saying that there should be a 50 basis point cut at the September meeting, and then another 50 basis point cut in November. But it's possible that they even make a rate cut before their next meeting. I don't think that is likely. They even call out that, if they do something like that, it's going to put more fear into the market. So I don't expect that. But it does sound like maybe in September we would see a 50 basis point cut. So why do we care about all of this? Because this is not the mortgage interest rate. This is the federal funds rate. But what happens in the economy and with the federal funds rate eventually impacts mortgage rates. And so last week on all of this news, rates plummeted for mortgages. We actually saw the lowest mortgage rates that we've seen in about 15 months. So it was a really big change. So for buyers, oh my gosh, if you've been searching and you didn't hear from your lender on Friday, make sure you reach out. Make sure you're figuring out what your mortgage would look like if you're under contract and you haven't locked in your rate yet. Take a look at these numbers because you could have some pretty significant savings on your monthly payment just based on how low mortgage rates went, or what a drop we saw at the end of last week. And sellers, this is good news for you too, because it's definitely going to spur some more buyer activity. We are going to see more buyers out there. You're probably going to have more showings on your listings this week, and hopefully you get an offer or maybe a few, depending on the situation. So here's what happens with mortgage rates. And I think this is really interesting how Mortgage News Daily has broken this down. They're talking about since we've started to see mortgage rates increase in 2022, we've climbed to these new highs, then we'll start to see a dip. We'll see some economic data that impacts markets, and we start to see mortgage rates come down a little bit, but it's kind of like a false dip because then we actually accelerate up to a new high. And this has happened 3 times where we've seen this. This last time we saw this dip, we came back up, but we did not reach a new high in mortgage rates. And now we're going back down. So what they're saying is this actually might be the first sign that we are going to see mortgage rates come down for the long term. Like maybe we're out of this volatile environment where we continue to increase and hit these new highs, that we're actually going to stay below these more recent highs and not climb back up and kind of live in a lower rate environment for a little bit. They break down what happens to the 10-year treasury based on some economic data. And if you're unfamiliar, mortgage rates really follow the 10-year treasury. And so it's important to look at where that's at. And I think this is just such a great graph showing exactly what has happened. So we got weak economic data and a friendly Federal Reserve. This was back in the end of 2023. And so based on all of that, we saw the 10-year treasury start to come down. And then in the beginning of 2024, we got some high inflation data and the Fed got a little more cautious. And so we started to see the 10-year treasury increase. With that, mortgage rates increased as well. And then as we got into May, and into the summer, the Fed started talking about being more open-minded to rate cuts later in the year. There was some low inflation data. Eventually, the 10-year treasury started to come down. We saw the same thing with mortgage rates. And then we got this weak labor market data. The 10-year treasury dropped, and so did mortgage rates. So if you're ever kind of wondering what to look at to get a good indication of what's happening with mortgage rates, follow the yield on the 10-year treasury. This also just shows some quick graphs on what's happened with the labor market. So non-farm payrolls or jobs that were added went down. Our unemployment rate went up. Average hourly earnings year over year went down. So you can see the reaction in mortgage rates. This is where we ended last week. Clearly a very significant drop in mortgage rates, bringing us to those mid 6s, which is something we haven't seen since about March of 2023. So that was really great news for both buyers and sellers. And we'll see how things progress this week. Mortgage News Daily is saying beyond the next 2 weeks, the next month and a half could be particularly volatile. As it stands, the market is second guessing the Fed's decision to hold steady this week and wondering if they'll be playing catch up in mid-September. We don't really have any big economic data coming out until the CPI, and that'll be next week. So we have a little bit of time to see if that kind of data will impact markets again. So aside from what happened with the economy and mortgage rates, we also have some good news as it relates to affordability. Housing cost to income ratio has barely changed, according to Housing Wire. So although Americans have complained about high housing costs for decades, their concerns have taken on a fevered pitch recently. This is talking about how home prices have increased by more than 50% since the end of 2019. And that's an annual growth rate of 14%. Far higher than the long run average of 4%. However, when you look at housing cost as a proportion of the after-tax income, most households actually aren't spending anywhere near 50% more. In fact, the large contingents of the population are spending the same proportion or less of their income on housing than they have in the past. So I found that interesting. So they talk about how incomes have actually increased. Affordability is about both prices and incomes. And according to the Bureau of Economic Analysis, over the last 5 years, the average personal after-tax income has risen from about $16,000 to almost $21,000, which is a 30% increase. Now they're looking at personal income and after-tax income, which is why those numbers seem really low. but we haven't had that kind of personal income growth over a 5-year period in 20 years. So in fact, the rise in incomes is not just a buffer against higher home prices, it's a cause. So they're saying that some of the reason that we've seen higher home costs is because we've actually had higher incomes and people have been able to spend more on their homes. But as a percentage to their income, that hasn't really changed much. So I find that interesting because I hear a lot about how incomes haven't kept up with home prices. And according to this article, they really have. In fact, we're spending less or the same on housing, even though home prices are higher. Now, it also talks about the interest rate impact and that the median home price in 2019 was $212 with a 30-year mortgage at 3.75%. Your mortgage payment would be $900. Now, the same house today costs $323,000. If it's financed at today's rate of 6.75, which is no longer, we're closer to 6.5 now, would carry a monthly cost of about $1,900. So it's $1,000 more per month now than it was in 2019. But if incomes have increased along with that, or at least increased a little bit, we're still seeing a similar ratio of what people are spending on their housing costs as compared to what their incomes are. So I thought that was interesting, kind of a rare find, because most of the articles that you see out there are talking about how incomes have not kept up, but Housing Wire is definitely a credible source. So I wanted to share that. I thought that was interesting. So let's talk about those underwater mortgages. But first, if you are new here, consider subscribing and being part of our community. I'm here every Tuesday talking about what's going on in the Phoenix housing market and the economy, and share this with someone who might find it interesting. U.S. underwater mortgages hit a 5-year low after equity boost. Told you I didn't have bad news for the housing market this week. U.S. homeowners enjoyed an equity boost last quarter and saw the number of mortgages classified as seriously underwater drop to the lowest in the last 5 years. That's according to ATTOM data. They say that 50% of the property's value in almost half of mortgage homes that homeowners held equity worth at least 50% of the property's value in half of mortgaged homes last quarter, a high level by historical standards. And moreover, around 40% of homes are fully owned. Meanwhile, the share of U.S. homeowners with seriously underwater mortgages dropped to a 5-year low of 2.4% last quarter from 2.7% in the previous months. They consider seriously underwater loans to have a loan to value of 125% or more, meaning that the owner owed at least 25% more than the estimated market value. So that is more good news for the housing market, that those number of homeowners that are seriously underwater has decreased as of this quarter. And obviously the increase that we continue to see in home prices is affecting this, right? It's giving homeowners more equity and therefore they are not at risk of being underwater. Let's talk about what's going on in Phoenix now. If we look at the CMI, the Cromford Market Index, which we look at every week, we're at 99.7. We are officially below 100, but I do have some positive signs when we look at every single city in the Phoenix area. I'll get there in a second. Our demand is at 73.8 and supply is at 74.1. So we're in a balanced market, both supply and demand being very, very close. Our demand gauge is actually correct this week. I know someone was calling that out last week, that this was pointing in the green section, even though it should be red. It looks like it's been fixed, so that's awesome to see. And overall, like I said, we're in a balanced market. Now, if we look city by city, you'll see a lot of red arrows, but the overall change month over month across all of these cities is negative 4.4%, which is smaller than the negative 5.4% that we saw last week. We also have a good number of cities that are still in sellers markets. Everything from Gilbert up to Fountain Hills is in a sellers market. And then everything from Tempe down to Paradise Valley in a balanced market, and Cave Creek down to Buckeye in a buyer's market. We've seen a few cities make some increases toward sellers markets. A few cities have some pretty large decreases away from sellers markets and towards buyer's markets, Gilbert and Tempe being two of those bigger changes there. And we also still have a few cities over 140, Avondale, Chandler, and Fountain Hills, meaning that those three areas are stronger sellers markets as compared to the other sellers markets out there throughout the valley. Now let's also take a look at the contract ratio because this is giving us an indication of basically the heat in the market. We're still seeing a lot of green out there, which is that balanced warm. We have a few zip codes that are now in this cold area, cold and colder range. Tempe 85281, Phoenix 85034, 85006, 85014, all of those in kind of that cold range. And then we've got a few hot areas, 85054 in Phoenix. We've got this Chandler zip still hot, Phoenix 85041, and then Tullison, and then a few other warmer areas as well. But overall, we're seeing a lot of green, which is that warm, balanced market, which makes sense. That really relates to what we were seeing in the CMI numbers as well. Now, with the changes in mortgage rates last week, I do believe we're going to see a lot more buyer activity out there. We'll probably see a lot of buyers who have been already looking, ready to actually make a move because interest rates are in their favor and they're ready to lock in. And then some buyers who've been waiting on the sidelines might be ready to jump in and start looking. So as a seller out there, I would anticipate that you'll probably see an increase in showing activity this week. Hopefully you'll get an offer this week as well. So if you've been on the fence about listing your home, now could potentially be a good time as we start to enter a lower rate environment, fingers crossed. And if you're curious about what your home value is, check the description below. I have a link to an instant home valuation. And buyers, if you've been on the fence and you're thinking about jumping in, check the description below. I have a link where you could search our MLS for homes for sale and at least see what's out there. Thanks for joining me this week, you guys. I will see you next week on another Tuesday market update.